Hello, folks. Happy holidays. Merry whatever you celebrate. It's been some time since we connected like this. I'm here with, this is my CIO, Simba. For those of you who don't know Simba, he's the perfect number two. This is like Charlie Munger or Warren Buffett. Right, well, I couldn't carry Warren Buffett's Depends, but anyways. Simba's a great number two. Don't let the sleepish look fool you. He's got a ton of ideas going on there, right, Simby? What's that? Or just says happy holidays. So, folks, I kind of got away from the video thing, at least publicly, but some requests came in to do a video this time of year, and we know that this could be a good time of year to kind of reassess things, take a pulse, do a little situational analysis, kind of figure out where you're at. It's good to do some housekeeping. So I want to talk today. There's some concepts that I want to bring out today that are in the investments portion of a comprehensive financial plan, right? I can't stress enough how many people I sit down with and they just want to get to the investment part, right? Of course, we all do. But we have to remember that this is just one of four major pillars, right, of any type of comprehensive life. I like to call it life planning, right? Because I think there's such a fusion between everyday life, behavioral finance, and our relationships, everything. I think it's all one big thing. So anyways, we're going to focus on investments, and I want to build upon some thematic investment ideas, folks, that play out time and time again. And if we want to be kind of responsible for our own money or responsible at the forefront of a decision-making process around our money and how we invest it, I wanted to go over some common themes that repeat themselves time and time again with a few baseline assumptions, right? These are things that have repeating correlations or inverse correlations, meaning that when one's moving up, the other may be moving down, or when one's moving up, they both move up, or when one's moving down, they both move down, right? Another baseline assumption here, we're going to gain inherent diversification via things like indexed and sector ETFs. And what I mean by that is it takes away, we can all do analysis by paralysis, right? The beauty of the ETF product is you can get more tactical and sectorized now versus even going more broadly through like an index. So you can take advantage of certain themes that play themselves out time and time again in a very low cost way with diversification, right? Which eliminates the need for most of us to look at things like 10Ks, 13Fs on individual companies, because inherently when we're index investing or we're buying a sector or sector investing or industry investing, we inherently are getting diversification across that index or that industry, okay? But again, I want to go over some certain things that throughout history have played over time and time again, and they're concepts that we can use. Again, I like to start at the macro level, right? Take an assessment from a macro perspective as to what's going on in the economy, what's going on socioculturally, what's going on from an industry perspective. And then I like to drill down from there, again, adhering to certain correlations and inverse correlations to certain things that we can take advantage of that play out. So, of course, history, right? I wanted to just start with a brief history 101. Because in the words of the great philosopher George Santayana, those of us that forget history are condemned to repeat it. Okay, it was something like that. I paraphrase. Anyways, so free money, right? This had been the concept, let's call it since the financial crisis of 2007 to 2009, right? There is a certain segment of the population that knows nothing but free money. Okay, because what happened as a result of the financial crisis, and I'm not going to get into the weeds there, is we had basically multiple rounds of what they called quantitative easing, or QE. You remember that one? Right? So that was a combination of very, very stimulative monetary policy plus the Federal Reserve Bank was buying up to 120 billion per month of mortgage-backed securities and treasury securities, with its balance sheet reaching a peak in April of 2022 of $9 trillion. Those of you who have been following me for some time, Ben Bernanke, who was the Fed chairman at the time, and then Janet Yellen, who followed him up. I like to call this their Scorpion Bowl, the punch bowl, with a topper of Bacardi 151. So basically, again, we were in this free money environment from, let's call it 2009, all the way up until essentially 2022. But there's a caveat here. We had a global pandemic, right? So when the COVID pandemic hit, for simplicity purposes, I'm using December of 2020, which is when a bat supposedly flew out of a cave in Wuhan, China. We then add to this free money world that we're living in. Again, the Bernanke-Yellen punch bowl that we're all drinking from. Woohoo, free money, zero interest rates. Yeah, take risk, boom. Right? We added 3 rounds of stimulus, essentially $5 trillion. And folks, I'm simplifying things here. I'm keeping things very high level, very dumbed down. We can always delve deeper on a specific basis if you want to reach out. Okay, and then, so we had the 3 rounds of stimulus, and then with that we had the Inflation Reduction Act and the infrastructure bill, the infrastructure spending bill, which are ongoing, right? So this to me, coming out of the free money environment with Bernanke and Yellen, right into a pandemic, this to me was the equivalent of the dude that's trying to start the dude that's trying to get like a fire pit going, or is out in the backyard barbecue, and he throws like gasoline on it or like squirts lighter fluid on it to get the thing going. That's what the equivalent of, I think, all of this stimulus was. And again, I don't care if you're on the left, right, or in the middle. I don't care what your political bias is. So anyways, this combination, right, of easy money policy, let's just call it easy money policy. You take this and you within the pandemic with lockdowns, right, and then by virtue of those lockdowns, you're closing down manufacturing processes, and you're also isolating China, right, which was, like, let's call it for simplistic purposes, 70% of the global supply chain, right? And then you have processing and farming. Everything in that supply chain was stalled, disrupted. You're stuffing, everybody's sitting at home getting their pocket stuffed with money, all vying for the same baskets of goods and services. Pelotons and weight sets and cars and lions and tigers and bears. You know what I'm talking about here. So again, this was a Keynesian demand side bonanza, right? Not to get into it, you're talking about supply side versus demand side economics, right? Honestly, it's a little bit of both, but folks, right? When you stimulate the demand side, to which they did, and there's no supply, right? Anyways, hindsight's 2020. So what did that result in? It resulted in inflation peaking at 9% in June of 2022. Right, so that's kind of like the where we've been, and kind of what we're crawling out of now, right? So the result, right? Reactions, right? So Jay Powell, who is not the Jay Powell in Westport, Massachusetts, who's a friend of mine, the Fed chair, right? Who took over for Bernanke, and he had been in a headlock by Donald Trump for essentially 4 years. Like, Trump's just got him in a headlock, just pounding him in the face, telling him what they're kicking him in the corner, muscling the Fed, right? Crossing that boundary of politics getting involved with the Fed, kind of like church and state. You want to keep those separated, right? So Jay Powell says, let's stop the party, okay? Oh, sorry. Hold on. Right, so again, what the first thing they started to stop doing is they stopped these monthly asset purchases, right? So they started to tighten right? Monetary policy, right? So they stopped buying or started to wean down, let's just say it, buying all the asset-backed mortgage-backed securities. And then they started to raise the federal funds rate, which had been stuck essentially since 2022 at 0 to 0.25%, right? And we saw that it just peaked in October at 5.25 to 5.5% with, 10-year yields peaked in October of this past year at 5%, a 16-year high, right? So we went from a free money, zero interest rate environment world to our current environment where we're at 5.25 to 5.5% on the Fed funds rate. Now, that's a benchmark rate, right? That's very important to realize. It's a benchmark rate that sets a ton of other lending rates, right? It sets rates for car loans, mortgages, anything, basically any type of loan you're taking out on a personal basis for any type of durable good is going to be based on that Fed fund rate, right? And it's also the bank-to-bank reserve rate that banks use to lend to each other overnight. Okay, so that is the Fed funds rate. So from 2009 to 2020, right, in this free money bonanza, Keynesian bonanza, right, we have a flattish yield curve, right? So basically, low rates, zero interest to 0 to 0.25% on the low end, and you had a 10-year that was, for the majority of the time below 2% or right near 2%. From 2020 to 2023, we start to invert on that yield curve. And I don't want to get into an economics lesson, but when your 2-year treasury yield is higher than your 10-year and your 30-year yield, there's effing big problems going on. It's a huge, huge harbinger of recessionary type activity, which we know hasn't happened, which fast forward to the rally we've had this past year, because the market's the best forward pricing mechanism there is, the stock market that is. It prices in expectations. Expectations were for a recession that has not yet happened, which is why you get that rip across the board pretty much that we've had this year. All right, so now that we've gone from 0 to 0.25 to 5.5 to 5.5 on the Fed funds rate, what does that happen? That led to increased borrowing costs for businesses and for all of us, higher discount rates. You hear that thrown around all the time. What I mean by that, it can mean anything from determining a pension fund liability to forward earnings on a high growth tech company, right? Which is why, tech got slapped in 2022 and growth. Let's just say growth got absolutely be-slapped in 2022 because there were higher discount rates for forward earnings, which makes the company less valuable. It's a very simple concept. That leads to, the higher rates lead to lower bond prices. That's an inverse relationship. Again, just remember concepts and theories here. That's all you need to know. So higher interest rates, bonds generally go down. And it led to an increased dollar, US dollar. That's a huge correlation that we're going to see. So, higher interest rates. All right, I broke this down into macro effects and to binary effects. This is where we get into some common themes that play out time and time again. Trust me on this. Okay? So the macro effects of higher interest rates, higher borrowing costs, right? We just talked about that increased price of the US dollar. If we go into binary effects on certain sectors and certain industries, right? Again, we talked about this. It's a negative for highly levered companies or companies that borrow a lot of money because not only are they paying more to borrow and are not getting funding to borrow, their forward earnings are discounted by a higher discount rate. Okay, so that's important. Let's go to a few assumptions here as I'm talking about this stuff. And I know this, obviously, folks, this is very unprofessional. But certain assumptions. So when I talk about the risk-free rate of money, I'm using the 2-year treasury in this case because we're in an inverted yield curve, right? So roughly right now, 5.2%, right? That's the free rate of money. that they would use as a discounting mechanism and stuff like that. I want to make an assumption on duration. When you hear me talk about duration, this is a very important concept, but you don't really need to get into the math on it. How I want you to think of duration is in two simple ways. For a change in interest rates go up 1%, i.e., right? What is the bond price going to go down correspondingly? So for every 1% increase in interest rates, how much does the value of my bonds go down? Okay, think about duration that way, and think about it just in terms of time frame, right? You need to match your duration with your investment horizon. Very simple concept that many regional banks last March kind of forgot, right? So for instance, if you have a 7 to 10 year investment horizon on your portfolio holistically, simply match the average duration of your fixed income investment to that time frame. Very important concept to remember, but that's the two ways I want you to think about duration, and they're kind of intertwined. And then when I say ticker, that means stock and or ETF symbol, right? And then also, yes, U.S. Treasury Secretary Janet Yellen is not Benny Hill. Okay, so anyways, when we get back to binary effects for sectors and industries, again, we have a negative for highly levered growth companies, which we saw in 2022. Tech took a beating because the weighted average cost of capital went up, right? This is extremely negative for, again, most tech, telco, media companies, to simplify, high growth type companies, right? And small and mid cap companies. When I say small and mid cap companies, I'm talking about companies that comprise the Russell 2000 index. So essentially a small cap is anything under a $3 billion market cap by most standards and for simplistic purposes of this conversation. Why? Because they borrow a lot, okay? Quite simply, small cap companies tend to borrow more, so they're infected more by interest rates, and they're also more affected by, they have a higher sensitivity to economic duress. Right, so small and mid-cap companies, tech companies are growth, digital assets, right? Digital assets, when I talk about digital assets, obviously, and we're not going to get into the weeds. You want to get into the weeds on that, I'll get into it with you all day, but not today. We're talking about Bitcoin, Ethereum, we're talking about exchanges like Coinbase, stuff like that, digital wallets. We're not going to get into that, but they were affected. Obviously, they fit into this whole growth trade. So it's kind of guilty by association type thing. Also with higher interest rates, a huge thing that plays out is a comp to the 10-year yield. What owning the 10-year bond, again, the free rate of money would pay you. A lot of industries and or sectors get compared to that because they're value/income paying stocks. This is a huge concept to realize. Okay, so when your interest rate goes up, right, on the 10 years, which means the 10 year, which means the bond price is going to go down, the yield's going to go higher, so they're yielding more, right? That's going to be compared to a high yield asset, right? Like think of companies that pay dividends. So value companies like financials, like utilities is the main one, and this is all going to come back a little bit here as we go forward here. Anything that pays income or you're buying for income generating purposes, real estate, right? That's affected in multiple ways depending on the type of real estate, whether it's commercial, whether it's residential, blah, blah, blah. Generally, higher interest rates friggin' crush real estate, okay? And a lot of REITs and or property REITs, mortgage REITs, investment products like that, they pay out a high yield or an income generating product. They're gonna be compared to the new risk-free rate of money. Right, so that stuff all got slammed in 2022, right? And this plays out time and time again. I'm telling you, these themes, these correlations, if you simply start there, you can start to work out, you can start to kind of, move yourself into a thematic or a dynamic that's going to play out very well for you this year, trust me, right? For multinational companies as well, right? Because of a stronger US dollar. So that's another big concept to remember here. With the higher price of the US dollar, right? What does that do? That attracts more dollars towards US denominated things that pay income, like US Treasury bonds. So when interest rates go higher and the risk-free rate of money goes higher, guess what? You attract more people into dollars to invest into those assets, right? So it becomes kind of self-fulfilling. So for multinational companies, because of the stronger US dollar, and there's 49% of S&P 500 revenue roughly is global, right? This makes the goods more expensive, right? Because the people are buying those goods in dollars and their currency has gone down versus the dollar, right? So now we see why 2022 was a freaking bloodbath, right? Because of all this sensitivity and inverse correlation to higher interest rates, right? Real assets, right, which also fit into this high yield comp thing. Anything that's comp that generally pays income and you're not looking for as much growth from, it's going to get smacked, right? Because the risk-free rate of money is higher, it's paying you more to just park your money in a bond, and the cost of debt for emerging economies. The last one I want to talk about. This is very self-explanatory in itself, and again, a theme that we can take advantage of, in my opinion, humble opinion, to start this year. Okay, because when you're an emerging economy, you are loaded with dollar-denominated debt. So again, when the price of the US dollar goes higher, your debt becomes more expensive because your currency is devalued versus the dollar. Also, a lot of emerging economies are commodity dependent, which are priced in dollars. When the dollar goes higher, the price of a commodity inherently goes higher, right? So they get double whammy. They get absolutely be slapped in 2022. Now is the time to be starting to look at all this stuff that was inverse to higher interest rates. So, 2024. Who would think? Simbi, 2024. What do you think about that? Huh? Okay. So 2024, here's some ideas to take advantage of these themes. Look, I know this is a mess. I'll kind of talk through it, and this is just ideation. I can always get more specific for folks if they want to reach out. All right, so as a result of all we talked about, 2022 was a negative for tech, telco, media, or growth. All right, I'm generalizing here, folks. Don't crush me. Was a negative for small caps because they borrow more, interest rates went higher. Was a negative for emerging markets. Their debt becomes more expensive. Commodities got blown out. And it was a negative for alternative type investments. I consider alternatives anything that's not a stock or bond. So we can talk about that a little more. We can always get more in detail specifically. And then 2023, woohoo, party time, right? Everything went inverse to expectations. And that's when you generally get a big rally. It never, despite the hiccup we had with the regional bank, I don't want to call it a crisis, but the regional bank hiccup, it's still going on to some extent as well, people. We had a really good year, but, that is something to talk about that kind of fits into this thematic, what happened with the regional banks, because it also brings back into focus and might crystallize that concept of duration. So, very simply, when we talk about things that got crushed by higher interest rates, right? It was the regional banking sector mainly at the beginning of 2023, because what they did, banks make money by what they call net interest margin, primarily, right? It's a very simple concept where they pay you basically bum kiss on your deposits, and they lend it out along the curve at higher rates, right? So they capture that spread between what they're paying out for deposits and what they're getting on it, what people are paying back in loans. You can only imagine right now if someone's taking out a 7.5% 30-year mortgage, right? And they're using money based upon deposits where they're paying like 0.25% on those deposits. Now, there's more competition for deposits. Again, I'm keeping things very simply, but quite simply, regional banks at the beginning of last year had this dynamic where they were taking their money and they were investing in longer term bonds. So anything further out in the curve, let's call it 10-year plus down to up to 30 years, right? They were taking money from deposits because people weren't borrowing as much money, so they were putting them into long-term bonds. Well, when you get into a cycle where people start to withdraw money from the bank, guess what? Because of that concept we talked about, where because bond prices are inverse to higher interest rates, their bond prices were lower because they're not holding them to maturity, so they had to sell them at a loss. So they were having trouble meeting the withdrawal requests or deposits that were being withdrawn from the banks. It's a very simple concept. You can see how a run on the bank happens, but that's what happened to the regional banks. Outside of that, we had a huge boost to 2023 tech, telco, media, with primarily on the heels of Gen AI. We can talk about that a little bit. And then we see what the markets did this year, right? The S&P was up 24%, the Dow was up 14%, all-time record, and the NASDAQ was up anywhere from 42 to 44%, depending, right? 2024 asset allocation. You hear a lot about the 60-40. It's been around, it's been around forever, right? 60-40, so 60% stocks, 40% bonds. I'm advocating to start the year 40-40-10-10. So 40% stocks, 40% bonds, again, because interest rates have made bonds more attractive. And there's a big assumption here, okay? When I talk about these ideas that we're talking about, we need to agree on a couple things. We've hit terminal interest rates, meaning interest rates at the least have peaked. They're not going any higher. Now, again, on expectations, this is what's expected for next year. This is important for all of us to remember. People are expecting 3 to 4 rate cuts by the Fed. If this does not happen, look out below, okay? But that's what they're expecting, because they're expecting what we call a softer Goldilocks type landing, where the Fed has raised interest rates enough to get inflation back on track or on a downward trajectory. So we have to believe that inflation's peaked as well and interest rates have peaked as well, right? For these concepts to work. I got in probably about 2 months ago. I started to look at these type of investments. I was a little bit early, as some of you know. Okay, but now what? It's worked out pretty well, right? We're up anywhere 7 to 9% depending over the last 2 months. But these are some of the themes that we can take advantage of. Again, if we believe that interest rates have at the least peaked, they have, trust me, I think, and that inflation now is at least on a downward trend back towards that 2% that the Fed prefers. It's actually, if you look at it a certain way, 1.6% over the last 6 months. So we have a good trend with inflation as well, which I'll be damned. Jay Powell, again, not Jay Powell in Westport, may pull off that Goldilocks or that soft landing. Anyways, I am advocating a 40-40-10-10 for a generic portfolio. That's 40% stocks, 40% bonds, 10% alternative investments, anything that's not a stock or bond, and 10% cash. How about that, right? We can actually do cash management now. You get CDs paying 5.25%. You got T-bills. You can, I've been doing a lot of cash management for folks, particularly folks who are later along in their journey and or are, saving for a house or a purchase or something like that. I've been doing a lot of cash management with folks. You can quite simply build a ladder of T-bills, right? So you can take $100,000 cash, for instance. You can buy a 3-month, a 6-month, a 1-year T-bill, right? And as those expire, and I think we'll get about at least a year more of rates on T-bills, that because of that inverted curve, this dynamic where you have shorter term interest rates paying more than longer term interest rates, I think we're still going to be able to take advantage of that. So still a good investment. You got money market funds paying 5% at Fidelity and Vanguard in particular. There's a couple of them that I'll point out. So again, cash management's a big thing right now, as you can essentially, for simplistic purposes, earn 4.8 to 5% on your cash, maybe even a little more if we look at different things. So here are some ideas to play with, again, in this environment that I believe that we're in. Again, terminal interest rates and inflation starting to go lower again. For domestic stocks, you're always going to I'm always going to want some type of baseline investment in the SPDR, or the SPY, which is the S&P 500 index, which is the broadest index of stocks. Again, with that inherent diversification. Now, one caveat here. again, I don't want to get too far in the weeds for purposes of today. Roughly 27% of the 24% that the S&P 500 was up in 2023 was 7 stocks. We all know what they are, right? So we're talking about the FANG Plus stocks. So Facebook, Alphabet or Google, Netflix, Amazon, Apple. Okay, all right. So that's 27% of the S&P 500. So you may want to consider an equal weighted, as opposed to market cap weighted, an equal weighted S&P product, which weights everything in the S&P evenly. Okay, the IWM or the Russell 2K, we talked about this, right? Small caps have been lagging. They got slapped because of, again, those higher interest rates. Small caps tend to underperform in a higher rate environment because of their leverage. I have been using, for some folks, the OMFS or the Invesco Russell 2000 Dynamic Multi-Factor ETF. What is a multi-factor ETF? It takes into consideration momentum type factors, right? It takes in money flows versus price change, right? And also, folks, okay, your grandparents would love this. God bless if they're still alive. The XLU, or the Spider Utility ETF, and the XLF, the Spider banks, right, where you get representation of Berkshire Hathaway plus JP Morgan, Bank of America, the major banks or money centers. I believe this is where it's been about a month and a half now, but this is where you're going to continue to get, particularly small caps, Utes, financials, all these things got crushed by higher interest rates. You're going to still get a little bit of relative outperformance, I believe, heading into this next year, particularly with stretched valuations because of the rip we had the second half of last year. These are relative value plays. What do I mean by that? Performance-wise, or from a capital appreciation perspective, they've lagged the general market, right? This group here. And also the dividend yields comp to the 10-year U.S. Treasury, which is at 3.84%. So they have very competitive dividend yields, right? So you have, in my opinion, well, it's been working out, but you have, in my opinion, with utilities, boring as hell. One point last year, they were down 17.7% when we started to allocate towards them, right? You have utilities, which you'll probably get relative price outperformance, and banks, which you'll probably get relative price outperformance, and they also pay, guess what, a very competitive dividend yield, right? So you could get a combination of both worlds there. And again, this is what they're going to comp an income type based investment off, right? Primarily. For bonds, okay, bonds are they're relevant again, peeps. They're very, very relevant again. Most generic way, biggest bond fund in the world is the BND. That's the Vanguard Total Bond that gives you a representation primarily of U.S. government debt plus a small sliver of corporates. That's the BND ticker. Treasury inflation protected securities. You might think, why? Inflation's starting to trend lower. No. See, tips, I don't want to I could do a whole thing on tips, right? It's very complex the way that they're priced, okay? But inflation is still going to trend over what they call the break-even rate. So the break-even rate is the rate that's set by the U.S. government on a Treasury inflation product, right? Less the 10-year yield. That's what they call the break-even rate. So as long as inflation stays over that break-even rate, right, you're gonna be winning by owning a Treasury inflation protected security. I believe it is going to stay higher than the 2.27% or whatever the break-even rate is right now. I believe it is going to trend that way. Tips have gotten crushed, so again, a relative value play. I believe you want to own tips right now in your portfolio. You can use the TIP, which is an ETF that gives you effective exposure with about a 10-year duration average. And again, you see the trend here, the TLT, the 20-year U.S. Treasury ETF. I think it's already up 17%. Or something ridiculous since we got in. But again, that concept of duration. One other thing is the bond price is going to be more affected by relative increases in interest rates the further you go out in duration. So anything 20 to 30 years, for again, simplistic purposes, for a 1 percentage point increase in interest rates, anything further out on the yield curve is going to be more adversely affected than things at the shorter end of the curve, which is why I think you're going to get relative outperformance of the 20-year Treasury ETF, the TLT. I think it will play some catch up. And then here we have the LQD, which is the iShares investment grade corporate bond fund, which that's basically like high rated debt for solid corporations. You have the HYG for a small sliver that you can think about. That's the iShares high yield bond ETF. For instance, that's got a 5.74% yield. And preferreds, crushed. Why? They have unlimited duration. Think about it that way. Preferreds are usually issued by banks. They're high-paying class of stock that's offered by a company that pays a very high yield. In this case, the PFF is a broad range. So again, you're getting that diversification aspect by buying the ETF. It's gotten crushed. It pays a 6.61% dividend yield. I think it's a relative value play with yield. Okay? Again, because if we've hit terminal interest rates or the high interest rates with inflation going lower, all this crap that got crushed because of higher rates and high inflation is going to play out. Okay? It's going to continue. It has been. It's going to continue to play out. For international stocks, okay, I'm thinking three things. Again, we talked about emerging markets. The simplest way, folks, I'm not going to really sit there and do research on China or Vietnam or any of these other emerging companies, India, that comprise emerging markets. The VWO, or Vanguard Emerging Market ETFs, the biggest one out there, gives your exposure to roughly 4,000 emerging market economy stocks. All right. The IDV, this is a relative value play for me. This is the iShares or BlackRock International Select Dividend Fund. Okay. Not only a dividend stocks, again, on that comp on yield, right, been getting crushed, but value-oriented stocks over, this is mainly the UK, like the exposure. They've lagged the market. I think it's a relative value play as well. So the VWO emerging markets, the IDV, something you can think about for yield, for dividend yield and potential growth. And then this one, China's gotten crushed, right? They've gotten crushed by COVID. They've gotten crushed by political policy. They're kind of annexed from the world right now. Taiwan, yada, yada, yada. I think it's time to dip the toes back in China. Easiest way to do that, again, folks, for simplistic purposes with diversification, is the FXI ticker, which gives you exposure to Chinese large caps. Okay. Alternatives. So basically, I'm saying anything that's not a stock or bond. So, if you wanted to look, and these are just ideas, folks. These are things to play with to take advantage of these trends that we're talking about, right? Hedge funds, that's, you got to have a certain 144A standing to be into a hedge fund. I can talk to you about that. Real estate, right? Real estate's getting crushed. We know about that, right? One generic way to play it is the IYR, which is a property REIT. Okay, it's going to pay a very competitive yield, and it's had a nice move. Okay, it's had a nice move over the next month and a half. You're going to get continued outperformance again as interest rates start to go lower. Gold, silver. Silver's got much more utility. It's got utility in technology as a conductor, other things. I mean, I always put a small allocation there. And then private equity, right? Not all of us have access to private equity. I can obviously get you access to private equity and some folks that I work with. But a poor man's way to play private equity, in my humble opinion, is Blackstone, which are also ticker BX. Blackstone, the company, they own vast amounts of real estate, private equity funds. It's a great way to get exposure for the average person, and they pay like a 3.3% dividend yield. I could be wrong on that. I haven't checked in a bit, but 100% like Blackstone, and it's gotten crushed. The private equity was one of those things in the whole growth trade that got crushed. That was part of the whole circle or cycle that happened with regional banks, with private equity folks pulling their money out of Silicon Valley, and wow, okay. Yeah, lions and tigers and bears. I don't know if I have anything on here. Well, that's it, folks. That's it. Just some ideas for you to play with. Again, past performance is not indicative of future results, although some of this past performance we want to forget. Yeah, and the one thing I guess I would talk to is the whole artificial intelligence trade. Obviously, we know since ChatGPT and what happened last year, folks, we can sit down. I can talk to you about that. I work with a lot of those companies in my consulting job, but for simplistic purposes, the Microsoft's through their Azure cloud practice. The Google is my favorite. I love Google. I love the diversity of the company. I love the ad play. I know they've got some legal overhang. Google is a great play on the AI trade. They've taken a much more responsible and ethical approach, in my opinion. And then you have NVIDIA, which makes the HT100 chips, which are hotter than a Jiffy Popper. So, you got ways to play this AI trade. It's a little long in the tooth. I think you're going to get an opportunity to get back into it. We might get a little bit of a, Santa Claus thing into the first week of the new year. I think you're going to get a pullback in the NASDAQ, which is where the majority of these stocks trade. So yeah, but yeah, it's great to talk to everybody. Christopher, this one was for you. I know you wanted a video, but just some things to think about. Most importantly, could not be more excited for 2024 with all the hats I wear for clients and friends. And I wish you the very, very happiest of New Year's and a great start to the year. Simbi, what do you got to say, buddy? Right. Yep, Simba says, just keeps it quite simple as usual. Short and sweet, just says Happy New Year. Take care, folks. Have a great New Year.